What is up, everybody? Dan again, stocktrades.ca. Welcome back to the channel. I'm going to dive right into it today. We have a lot of questions on a very popular stock. It trades both in the US and in Canada. In fact, primarily a lot of its operations are in the United States, and that is Algonquin Power and Utilities. We have gotten a insane amount of emails from our subscribers, from our premium members, because this once was a premium highlighted stock, and a lot of people are asking whether or not this company is a buy after earnings. It tanked nearly 20%, I think, on earnings day after a very, very poor quarter, and I think a lot of investors, especially those who are looking for income, which if you're investing in utilities, you probably are looking for income, but they're wondering now that this stock is yielding, 8+% nearly, if it's worth buying today. So I'm going to dig a little bit into the quarter, my overall opinions on Algonquin Power, because I own this stock, pretty frustrated shareholder for the past while now. But I'm going to take a dive in. I'm going to give my opinion on the dividend. I'm going to give my opinion on the future of the company moving forward and what I'm going to be doing with my position in the next few weeks. So let's turn to the screen and get started. So the first thing I want to do is just go over the quarter. So as we can see, it was a challenging third quarter despite year-over-year growth in adjusted EBITDA, and I'll get to that in a bit, why adjusted EBITDA actually shows more of a warning sign than anything. Our results for the quarter came in below expectations, significantly below expectations of investors as well. They were negatively impacted by increasing interest rates and the timing of tax incentives related to certain renewable energy products. Our underlying businesses remain strong. However, we are not immune to the macroeconomic environment. Our team is focused on identifying and implementing necessary adjustments while they execute their 3 pillars of growth. So the thesis for me, as an Algonquin holder for a very long time, this company had a very strong growth rate. It had very strong profit margins. It had very strong dividend growth. You could not find a company in the utility sector that was increasing its dividend at the pace that Algonquin was. And it had a near double-digit dividend growth rate. I'll get to it in a bit, what I expect to happen in terms of dividend, but let's keep focusing on the third quarter. So adjusted EBITDA came in at $276 million, which is an increase of 10% compared to the quarter of 2021. But the thing about adjusted EBITDA and adjusted net earnings and adjusted funds from operations, these are adjusted numbers. They are non-GAAP. There's a reason why these numbers are not GAAP. Yes, they do provide us with a clearer picture of the available money that a company might have to pay the dividend, and just an overall better look at a utility's actual operations, because they do have a ton of capex that is, might impact GAAP numbers, but not necessarily impact the cash flow available to pay the dividend. But when we do look at adjusted EBITDA, let's see if I can find the table here. The one thing here that should be concerning is the interest expense factored into adjusted EBITDA. We can see that year over year, this company's interest expenses have gone up by nearly 50%. In fact, when we move from the press conference into the actual report itself, we can see that interest expenses through the first 3 months of September 30th, 2022 were $23.3 million. Through the first 9 months, interest expenses sat at $38.2 million. So we can see that interest expenses in this quarter alone almost doubled that of the first and second quarter in 2022. And the one important thing to understand about interest expenses is they are a cash outlay. This isn't like depreciation or amortization where it doesn't actually cost the company any money. Interest expenses are real and they are paid every quarter. So if we go back to the company's outlook, and which is primarily the reason why this company took a 20% dive on earnings day, the company adjusted its outlook in terms of adjusted net earnings from 72 to 77 cents down to 66 to 69 cents. This is a regulated utility. Algonquin still does have the vast majority of its operations in regulated utilities. A 10% downwards revision in guidance is pretty significant, and whenever something like this happens, the dividend is always going to be thought of as at risk. I mean, it's fairly obvious there is going to be headwinds for this company moving into 2023 and likely even 2024. That is why the company came out and downgraded this guidance. Now, I know that dividend payout ratios when it comes to utilities are very, very complex. And most of the time we'll end up using adjusted funds from operations, which do show that the dividend is still safe in this regard. But whenever we have a utility like Algonquin, which did have tighter dividend payout ratios than some of its other peers, and we see this company downgrade its net earnings guidance by this much, it is always going to raise concerns, and it is a large reason why this company lost 20% on earnings day. Overall, we are in a very, very risk-off market right now. So when Algonquin gives an update on its longer-term targets and pretty much says it's in the midst of evaluating those long-term targets, and you won't really hear about them until the Investor and Analyst Day, which is in early 2023, this is going to cause a lot of uncertainty with investors, and a lot of people are going to move on because, for one, people buy utilities for the income. They're not going to provide you with outstanding capital returns. For the most part, people hold utilities for the income. So when something like this happens, again, the dividend is the number one focus, and that dividend being at risk is very real. So this is why a lot of people sold off, and this is why the stock tanked on earnings day. I am not somebody who believes in a completely efficient market. I do believe that there is opportunities to take advantage of short-term panic, but investors really need to understand that when a company falls 20% on earnings, where there's smoke, there's fire. There is real risk here that the dividend could be cut, or at the very best, dividend growth is likely to slow. It is, although not guaranteed, practically guaranteed that Algonquin's days of high single-digit dividend growth are over. I would not be surprised at all, and I'm speaking best case scenario here, if the company came out next year and announced a low single-digit increase to the dividend, which would be significantly lower than this company's typical averages when we look to dividend growth. This is a company that is being hit hard by rising rates. It's somewhat unfair to blame the company to an extent because the rapid increase in policy rates is arguably, actually it is the fastest we've ever seen in history. But if we look to CEO comments, they called the quarter challenged. CFO Darren Myers said that higher borrowing costs and tough economic conditions are expected to remain a headwind for Algonquin into next year. So looking ahead into 2023, they expect pressure from increasing interest rates and broader economic conditions to continue to impact their earnings. How much? That's difficult to say. The one thing that's very important to understand is this company is struggling with interest rates, and this company is struggling with inflation, and the large-scale acquisition of Kentucky Power hasn't even closed yet. In late September, they already amended the acquisition to reduce the purchase price. Algonquin will be assuming $1.221 billion in debt. Now, Algonquin did say that the acquisition would be accretive in the, I believe they said the next calendar year, but they did end up putting off that accretion and said it would happen at a later date. So there is large-scale risk here that, difficulty in integrating this acquisition would cause issues for Algonquin. And if there was issues with the integration and synergies of this acquisition, a dividend cut would almost be a certainty. So again, there's a lot of uncertainty here as well. So obviously the quarter was bad. I don't really need to talk about the quarter much anymore. A lot of people want to know if Algonquin Utilities is one of the more attractive options in the utility sector today. So we'll compare it with some other major utilities here in Canada using our screener and comparison tool. So I've added Algonquin, Fortis, Emera, and Hydro One to the comparison tool. So we're going to take a peek at Algonquin from a standpoint to these other utilities. Obviously, out of these three utilities, Algonquin is the smallest, especially with its rapid decline in share price recently. We can also see, at the time of filming this video, it does have an RSI of 26.5, so it is oversold, whereas all the other utilities are firmly in neutral territory. Now, our Stocktrades growth score and our Stocktrades dividend score, it's something we keep at Premium to analyze the overall growth of the company and the overall safety of the dividend. The growth score is a 4 out of 5 because originally Algonquin Power was expected to grow at a pretty rapid pace relative to these other utilities. I would expect that this growth score is going to decline. You're probably going to get a lot of analysts who are going to come out and lower their forward growth expectations for Algonquin. And in terms of dividend score, it does have the poorest dividend score out of all four of these utilities. It has had that poor score for pretty much the existence of our screener here, primarily because this company, their dividend is tighter in terms of payout ratios rather than looking at a company like Hydro One, like Fortis, or like Emera. So 1.9 out of 5. This could potentially even decline moving forward because we do factor in dividend growth. So if Algonquin's dividend growth slows, or even worse, it stops and it loses its dividend growth streak, this 1.9 out of 5 is going to continue to fall. So in terms of valuations, it is the cheapest out of all these utilities, actually by quite a landslide. Trailing price to earnings, I'm not really using that too much, but when we look on a forward basis, it is trading at a very steep discount relative to Fortis, Emera, Hydro One. But the thing is, these other three utilities, there's not much uncertainty moving forward. None of them have, revised guidance. None of them have pointed to forward-looking struggles. So as a result, people are going to pay less for Algonquin on a forward-looking basis just because of that uncertainty. Now, we can see that we have a PEG ratio, price to earnings to growth, of 0.37. When we look to the other utilities, the only one that has a PEG under 1 is Emera. As of right now, the market is not factoring in Algonquin's forward-looking growth into its current share price, but again, this is relative to analyst estimates. So it is highly likely Algonquin is going to be downgraded moving forward, and you will see this PEG increase. Whether it goes above 1 or not, I'm not really sure, but overall, I would not expect this to stick. Now, from a debt perspective, it does have the worst interest coverage ratio out of all these utilities by quite a wide range. Utilities can typically maintain relatively low interest coverage ratios just because of the reliability of their cash flow, but it is important to note that Algonquin does have the worst out of these other three major utilities. Profit margins. It did have for quite a while the best profit margins out of the utilities, but as we can see, profit margins are definitely starting to dip on a trailing 12-month basis relative to their 5-year averages. Not necessarily like a clear warning sign, but it's definitely something you want to keep in mind. There can be a lot of one-off costs that impact profit margins from a short-term perspective, but as we can see with these other utilities, their profit margins are trending relatively in line with their 5-year averages. And Algonquin's has, reduced quite a bit. So there is another potential warning sign for investors to look at. It has been the fastest growing utility on a revenue basis by a landslide. I mean, if we look at, 22% 5-year annualized revenue growth, it doesn't even come close. These other utilities don't even come close to that. But when we look from an earnings per share perspective, this company only has 3% earnings per share growth 5-year annualized. The other utilities have been better at growing their earnings. And in the past, Algonquin has been very, very good at accretive acquisitions. And with Kentucky Power expected to be accretive, if everything goes well with that acquisition, it is very likely that Algonquin does see strong earnings per share growth because of it. But again, with the uncertainty and the fact that they did revise the acquisition price, the company has somewhat spoke on how accretion could come a little bit later rather than sooner. There's a lot of doubts right now. So when we look to growth moving forward, 22% expected revenue growth next year, I expect that to come down. The 9% earnings growth, I do expect that to come down again. These are analyst estimates. They are going to be downgraded after that quarter. The company reported on Friday, so clearly not enough time for analysts to get new targets in, but I do expect these numbers to come down. When we look to the dividend, it is the only utility that has a payout ratio in over 100% in terms of earnings. Payout ratios in terms of earnings, they're better than cash flow when it comes to a utility. We can see here, you look at the free cash flow payout ratios of some of these utilities, negative 134%, positive 265. Free cash flow is not a very good indication of dividend safety when it comes to utilities at all. But earnings is a little bit more reliable, but still not the be-all, end-all. A lot of companies use AFFO, adjusted funds from operations. And when we look to that standpoint, Algonquin Power does seem to have a dividend that is well covered. But again, with the forward-looking outlook that is really murky, a lot of comments on the fact that this company is going to struggle heading into the next year or two. These payout ratios can definitely turn sideways relatively quickly. Dividend growth streaks, Algonquin has an 11-year dividend growth streak. But we do have to remember that this company did cut the dividend in 2008, 2009 before resuming dividend growth post-financial crisis. So when we look to a company like Fortis, if we go back to the comparison tool here, 48, I believe it actually has 49 years of straight dividend growth. Right now, we just haven't added that extra year in. This company has a long history of not cutting the dividend, whereas Algonquin is only a decade removed from a dividend cut. So this is going to be sitting in the minds of investors as well. And if we look to 5-year growth rates, we can see that, Fortis, they've been very reliable at growing this dividend within range. It might come in lower moving forward. In fact, the company did say that dividend growth is likely to come in lower, but we don't see much of a discrepancy between the 1-year growth rate and the 5-year growth rate. Same with Emera. Hydro One's a little bit different. It actually increased the dividend more than its 5-year historical rates. But when we look to Algonquin, 8.79% dividend growth rate, I wouldn't say it's an absolute guarantee, but it is very, very, very likely that these high single-digit growth rates are over. Overall, I guess I'll finally answer the question that a lot of people have been asking me: am I adding to my Algonquin Utilities position right now? And the answer is no. I believe this is pretty close to a thesis-changing quarter for me, especially with the company's forward-looking comments about struggles, about interest rates, about debt levels. So to me, and I've been telling this to our premium members for quite a while, I would much rather hold into uncertainty than buy into uncertainty. I know it is very, very tempting to buy this company at an 8% yield and a 20% dip. And could there be a short-term recovery? Absolutely. And if the situation improves for Algonquin moving forward in 2023, could this dividend be maintained? And as a result, quite a bit of potential in share price? Yes. But I also believe that this is a very high-risk bet on that probability right now. If I were to guess, I would expect forward struggles from Algonquin, not forward recoveries. And over the next few weeks, I'm actually going to be thinking pretty hard about selling my position and moving on from the company. I view my other utility holdings, Brookfield Renewables and Fortis, as much better opportunities. I'm going to be adding to those moving forward. I'm not going to be buying Algonquin. Overall, when we just look at the addition of debt relative to other utility companies, this company has taken on a lot of debt. And in the past, when money was very cheap, this was a good thing. The company used it to fuel growth. But now it's heading into a situation where I believe 20% of its debt is floating, but that's definitely going to impact the company. Interest expenses, as mentioned, are a cash cost. And I believe, and I'm not absolutely certain on this, I would have to check the conference call. I can dig in a little bit more, but I believe that all of its debt from the Kentucky Power acquisition is floating as well. So we're going to see these debt levels increase, and we are definitely going to see interest expenses increase. So moving forward, this just isn't something I'm looking to add, and it is something that I am debating on selling. If it continues to post weak quarters like this, in my opinion, a dividend cut is highly likely over the next few years, and almost a guarantee that we're going to see a dramatic slowdown in dividend growth for Algonquin, which was one of the main reasons I owned it in the first place. If it's going to start growing its dividend lower than a company like Brookfield Renewables or a company like Fortis, I would probably rather just own those. They're more established companies with overall healthier balance sheets. So everybody, really hope you liked the video. Overall, I think that Algonquin Power does have a chance of keeping that dividend intact, but at the very, very best situation, I think we're going to see a severe reduction in its dividend growth as it really struggles with debt levels. And this is even before the Kentucky Power acquisition has closed. I don't really believe that selling into this type of volatility and this type of panic post earnings, I guess, is the best thing to do. I typically wait a few weeks, let the market digest a quarter. We could see a short-term rebound here, but overall, my confidence in Algonquin Power moving forward is not that high. I would say there is a good chance that we could see this dividend get cut. The company has done it before. Overall, I mean, any utility yielding 8%, any company yielding 8%, you should be using a lot of caution. As mentioned, I am far from an investor who believes that the markets are fully efficient. I think there is opportunities to take advantage of short-term emotional moves, but also I do believe that when a company falls 20% on its earnings day, where there's smoke, there is fire. This company does have issues right now, and those issues are likely to get worse moving forward. There is a reason that this company downgraded guidance that severely. But again, if you like this video, smash that like button. Make sure you subscribe to the channel and stay tuned next week for more great investment content. See you next time.